I'm super excited about this next panel because I believe impact investing to be one of the greatest aggregators of social change in the world we live in. Please welcome to the stage Managing Director of Sakihwe Capital Partners, Aubrey Sibanyoni, CEO of CarePrint Wealth Management and Chair of the Nexus Impact Investing Group, Vanessa Grellet, and Dirk Sampselle, CEO and founder of BRevolution.
Hi, how's everyone doing? It's that part of the afternoon where you're in like the post-lunch haze. You're gonna get some legal mumbo jumbo. So my name's Dirk. As you mentioned, I'm the CEO of a company called BRevolution, and I'm also currently the general counsel and COO of an asset manager that sponsors 2 venture capital funds focused on clean tech investment. And just to follow on to this question that was just asked, what is the difference between a B corporation, a benefit corporation, and an L3C?
Right.
Okay, got the question right.
Or other legal concoctions that are
sure. So
relevant.
kind of like the legal entities that you could use for a social enterprise. Just by way of background, I drafted the legislative memorandum to help advocate for the benefit corporation legal entity when I was in law school back in 2009. So I was active in that movement, and I've got a kind of a white paper out there. If you go to SSRN and just type in my name, SSRN, Dirk Sampselle, there's a white paper called Choice of Entity for the Social Entrepreneur or something like that. It's the only one on there, so you'll find it pretty easily. And that actually does this, a more thoughtful, written out analysis of the different types of legal entities. So just to give you some of the really quick and easy distinctions, starting off with the difference between a benefit corporation and a B Corp. They talked about this a little bit earlier. The B Corp is a certification. So it's like organic or fair trade, or what's another certification? LEED, right? That's a common one. So it's a certification. To get certified, you take the B impact assessment, which is basically this menu of all the different ways that you can do good things. It looks at governance, workers, social, the environment, and your actual business model, and asks you questions about them. Do you have an audit committee? Not really applicable for a startup, for a growing business. It's important. Do you give workers, time off to volunteer? Considers everything. Greenhouse gas footprint, very comprehensive. To be a certified B corporation, you have to take the B impact assessment, which is free, and score at least 80 out of 200. So once you do that, you have to pay a small fee. Usually, they base it on revenue. It's a small percentage of your revenue. It's kind of how they create the fee buckets. And then you get to call yourself a certified B corporation. There is a legal component to that. So it's not a legal entity, but there is a legal component to that. So to become B Corp certified, take the B impact assessment, get at least 80 out of 200, pay the small fee to be certified, and you must, within 2 years, amend your governing documents, whether that's an LLC, you could be a corporation, amend it to become a benefit corporation, or whatever. They provide ways to do it for each type of legal entity to basically bake the mission into your corporate legal structure. Okay, so that's certified B corporation. That's a certification, not a legal structure. Good. One person's listening. Okay, so a benefit corporation is a corporation. It's a legal entity. It is not a regular corporation. It's just a different type of corporation. It's not an L3C is a type of limited liability company. That's not a corporation. That's a limited liability company, LLC. It's a form of LLC. So the benefit corporation is a corporation. It is a legal entity. You can form it in, I guess the count is, I know it's over 30. Is it 30? It's
31, I think we decided.
Yeah, so we're going with 31. Each state statute is a little bit different. What you need to know or should know is that many of the states require something called a general public benefit purpose for the entity, which means that the language varies, but create material positive impacts on society and the environment from the operations of the corporation assessed as a whole. So it's kind of like some somewhat nebulous legal jargon, but it means kind of you're doing good stuff, and it's baked in there. The effect of that is that a shareholder in that corporation, a public benefit corporation, can actually bring an action as a derivative action, a shareholder action, to ensure that you're pursuing that purpose that is now in your legal governing documents. Most of the states allow you to state a specific public benefit purpose. So that was your general public benefit purpose. Most states allow you to state a specific public benefit purpose, which you get to make up, right? And so that could be...
Transforming global finance.
Boom.
That's what CarePrint does.
Yes.
Because we're a public corporation.
All right.
Delaware.
So that's a specific public benefit purpose. And you could, as many people as are in the room, you can have specific public benefit purposes. You can actually state multiple specific public benefit purposes if you want to. So that's kind of the nutshell. I don't want to drone on and on with legal jargon. There are two other attributes of the benefit corporation you should probably know about. One is that Delaware is different from all the other jurisdictions in that it does not have a general public benefit statement. So if you want to just have strictly your customized, whatever you define your specific public benefit to be, that is a jurisdiction that allows you to do that, whereas the others generally almost always have the general public benefit requirement. I believe Florida is one of those. But the two other attributes that you know about, most of them require you to consider your stakeholders and your board decision making. So as a board, as the governing body that manages the operations of the organization, you have to consider your stakeholders. So the statutes typically define those as the environment, community. They give you a list of who they think your stakeholders are. You have to consider those. And then finally, last attribute that's a major one is the public benefit report. So most states it's once a year. Delaware it's at least once every 2 years. You have to issue a public benefit report that reports on the good stuff that you're doing and the ways that you may be failing at doing the good stuff that you'd like to do. So that's the nutshell. I feel like Mark did a great job with the L3C. It's a modified form of the LLC. One attribute is that the public benefit corporation doesn't have any limits on your ability to pursue, generating revenue, generating income, generating profit. There's no limiting language on that, other than insofar as your public benefit purpose actually might do that kind of indirectly. The L3C, on at least the statutes that I read, again, every state statute's different. I think most of them have some language that say that no substantial purpose of the organization can be the production of income. So depending on which jurisdiction you'd want to form one of those in, you should maybe talk to Mark and see if it has that language and figure out if that is a limitation that you want to put on yourself. That limitation tends to help you, can help you qualify for certain grants and programs, things like that. So it can help you, it could also limit you. So I could go on all day about that, but I don't want to.
What was it, SRSC?
SSRN.
SSRN.
Yeah, it's kind of like a
Google that
repository
up
for draft articles.
Yeah.
So SSRN, Dirk Sampselle, you can read all about it.
Good. So I told you guys that was going to be simple. All right, let's get into this. I want to talk about impact investing. Vanessa, let's start with you. Just give it 2 seconds where you're coming from. Aubrey, 2 seconds where you're coming from, and then we'll roll with it. But
sure. I'm the CEO of a company called CarePrint, which basically tries to help you align your investment with your values. So it's a tool that's going to be able to help you define your values and then work with your financial advisors to reassess your portfolio and align your portfolio with the results of your values and the companies that are aligned with those values.
So does that mean you're like, can I give you my money? Is that how it works, or do you?
We don't manage money ourselves. We work with the entire wealth management industry, and we want to help them engage in the dialogue also with the millennials who are going to inherit $30 trillion in the coming years, to understand what their needs are and how they really want to engage with their investments. And my nonprofit job, I would say, is that I'm the chair of the Nexus Impact Investing Group. Nexus is a global movement of second-generation philanthropists and impact investors and social entrepreneurs. There's 3,000 of us globally, and we meet every year at the UN and at the White House, and we really come together to advance philanthropy and impact investing. And our group, on a continuous basis, is at the forefront of impact investing because it has the means to deploy capital, and we can speak about some of the hurdles of impact investing because it is there's a high threshold to get into impact investing. And we really want to advance the dialogue. It's also a millennials group, so everyone is under 40.
Is it high net worth individuals or is it institutions?
It's high net worth individuals representing their foundations or their companies.
Great.
Got it.
It's
All
early
right.
stage, it's like angel or?
So, well, you can come to the definition of impact, but impact is early stage, but it's also public markets, it's, bonds, it's very, very broad.
Aubrey, where are you coming from?
Well, I think that Dirk said it all. Good night. Thank you for coming, people. Let's just go on home. I also noticed that the room back there is getting a bit light, so I'm sure that people are.
This is gonna get exciting. So pay attention.
I think they are missing the main event here. So let's rock and roll.
That's why you're here.
No, you're the main event. So I'm the co-founding partner of an advisory private equity fund. It's called Sakihwe Capital Partners. Our focus is Africa. We are looking for mid-sized entities and invest in them and basically get involved operationally. We think that there are more opportunities in the mid-market, but we also do think that there's a gap in the skill set that we can fill in. When we talk about impact investing, especially the mid-market level, what's really missing is the value add other than capital. And for the emerging markets, emerging regions, that's what we want to foster. And I think if
What
we
does that
can
usually mean? Skills?
So skills, management processes, compliance, governance, these are the short forms that you see. Because a lot of the mid-sized entities are family-owned, 30, 40 years.
And they're what? Foundations?
These are your manufacturing
family
plans. Well, basically it's a family capital, but these are manufacturing entities and farming, for example. I just got back from South Africa. I was advising on 2 transactions. Really beautiful, beautiful deals. The only thing is there is no succession plan because one of the owners, he's 72 years old. He wants to retire. He's got 2 beautiful daughters. None of them are interested in agriculture. And so it's time for him to realize some gains and God bless him, go to a wonderful sunset. So we want to come in and give him some advice, help through the succession plan, ask him to stay an extra 36 more months as we go through that succession plan, and help the new business owners, which will also include the employees. Now that's the impact side that we're going to get into it. So I'm excited. Let's rock and roll.
Now that's cool. Tell me a little bit more about how it's working for you. It's not so much, I have a bunch of money and I want to do something good with it. This is a little bit more complicated than that. You're talking about, established families with an ownership. Just explain that a little bit again about how about a typical scenario is playing out that you're helping manage.
So typically, Sakihwe Capital was structured. So my background, since I did not talk about my background, I come from corporate investment banking. I worked for Citigroup for a number of years. I managed a relatively big department. From there, I wanted to get into the private equity position. And so I was hired as the Africa expert. We did some really cool things for this particular fund. But I wanted something more. I realized that what we were doing was pretty much not enough. And we were also selling a product in Africa that was really hard to sell, right? So we were second lien in all assets, right behind the banks. So we were taking more risk. And relatively speaking, when you look at the returns, the banks, in emerging markets, the lending rates are somewhere, 8, 9% plus, 300 basis points. And so when you look at what position are we coming in, basically we have to look at nothing less than 15, 16%. So the company is way lower than that position. And I think being able to service the debt instrument became very, very difficult. And my thing was, why don't we look at convertibles and look at debt, equity positions? And so the idea of starting a fund that would service that portion became the idea. What was different then became, well, the companies I would invest in, do they have the impact side of things? And the question was, no, they don't, because I'm going after, the mid-market entity. So if you ask me, what's the mid-market entity in an emerging, region like Africa? Somewhere between $15 and $30 million, that's your mid-market entity. Anything below that becomes smaller. So those guys, as I said before, they tend to be family-owned. So if you say to the business owner, look, we want a percentage of your business to be given to your employees and you'll get preferential rates, it's music to their ears, and that's what the fund brings. But it also brings the sense that we have our own capital that we can inject into it, so you have more negotiating power versus just say, hey, this is how you should do it.
Music to the ears of the employees, but also
And
to the
owners.
investors. Tell me how that plays out. Is that an example of the impact that you're talking about when you're talking about impact? I mean, tell me how impact, ultimately pays back the investor.
So when we take a step back, impact investing has been around since the 60s. It's just that it's almost like this dirty word, so to speak, that not a lot of people are comfortable with. I'll give you an example. I was invited to speak into a conference where they had a lot of limited partner investors in the room, and when we mentioned impact investing, they go, oh, so you're talking about philanthropic work. That's the connotation that it has, and also if it's not philanthropic, it's a question of, so you want to do good without the returns. And my argument was, no, this is a double bottom, right? We want the returns, definitely, because without the returns and success of the business, we cannot replicate the impact side of it. So that has to go hand in hand. And so, they are now getting hold of what it means. But this is a term that's been around for the last, since the 60s.
That's good. So I've always thought of, philanthropy as sort of like entry-level impact investing. And from more like a corporate perspective, it's sort of like entry-level corporate responsibility. It's like, hey, we got some money, we donate money to this cause, and somewhere down the line, someone decided, this is from a corporate perspective, that you could be strategic with your philanthropy and align it somehow with the purpose of the business, and then somehow down the line that evolves into something that becomes more of a core of the business, and perhaps somewhere down the line from like family investors or maybe institutional investors or something, you figure out this way that there's a return that's a viable return somehow. Does that make any sense? And either way, I'd like you all to tell me a little bit about how this idea of a return on your, either a return on your philanthropy, or if it's a impact on your, a beyond financial return on your money. Tell us a little bit about how this has evolved in your positions and how you've seen it, and how it's actually playing out as a benefit to the people you work with.
So let me just give you a case study. There's a fund called 1K1V, so it's 1001 Voices. The founder, his name is John Coors. So John Coors is the great-great-grandson of Rudolph Coors, the founder of Coors Brewery. Him and his family and his wife,
Coors,
Coors beers.
Okay,
Coors
yeah.
For the beer drinkers, I'm sorry to bring out Coors beers. I see a lot of mouths here getting pretty thirsty. So what he did was he used to go to Kenya a number of times a year, and he loves the country, loves the people there. But he saw a lot of hardship, and one of the things he wanted to do was, can he and his family create a sort of like an investment vehicle that would help alleviate some of the hardship that he saw in Kenya? So the friends and his circles that he moves around in, these are folks that are extraordinarily wealthy. They don't have an issue, donating $10 million and 30, whatever. But what was missing was the fact that if they gave to a nonprofit this year $5 million, they have to do it again 2017. So the idea was, if we can create an investment vehicle, go to Africa and have an impact fund, that $10 million we all donated to this fund will always keep going, because we can invest in factories, we can give people jobs. It could be a self-sustaining entity. And so that's an awesome plan when you think about it. And the idea is that without profitability, it is impossible for 1K1V to succeed. So when they go through investments and they think about which investment should we pick, the fact that they want successful companies is on the forefront, because now we have to marry the returns alongside the impact. So it's not neither or. You gotta have them both. And so that model is what we need more, especially in emerging markets like Africa, more so than in the US. Because in the US, we have more capital markets, we are much more diverse. But down there, I think we need more of that, right? So let's bring up the middle class by getting them involved in ownership structures. But let's also make sure that we go after profitability. So I don't know if you guys see the same way. Or.
So actually, we were talking, I think yesterday or maybe earlier today about how many people are familiar with ERISA? Is that relevant to anyone in here? Okay. All right, maybe we won't spend too long on this. So ERISA is the set of laws that govern how pension funds invest money. And just, I don't know, I guess last quarter, they issued a new interpretive release discussing the way that plan managers can consider ESG in making investment decisions. So there's a pretty stringent set of guidelines that risk managers typically have to abide by. It's called the prudent man rule. And how many people have heard of prudent man rule? Should be more hands, because that's not just ERISA. Okay. So it was an interpretive release talking about the way that those rules can be applied, and essentially said that ESG factors can not only be applied in a tiebreaker situation, so where investments have the same apparent risk-adjusted return, you can use ESG to break a tie. That was clear. But the new kind of statement there, the clarificatory statement, was that you can also use ESG before you even get to that point where you're actually analyzing the fundamentals of the business to look at how ESG can contribute to the return in a bigger picture way. So I have an interpretive release white paper out. I recommend looking up the interpretive release if you're interested in it. But it talks about how plans can consider those things. So that's a really important, I guess, adjustment or clarification in the law, because this is a huge amount of money that's managed by pension funds that could be either constrained by being afraid of considering those type of factors when making an investment decision. Are they allowed to think about the jobs that are created in Africa by making an investment there, or can they have to put blinders on and not consider that, right? So all that's to say, at the asset manager where I work, we manage several pension funds' money, and in some cases, we'll try to source investment opportunities that align with the job creation efforts of the underlying union that is the source of the pensioners' money, right? So sometimes we have a double bottom line approach. We also have two clean tech funds where they're thesis driven for energy storage, grid solutions, that kind of thing. And we focus on those things. So for us, we call it being thesis driven. You sort of define the buckets of the impact that you're trying to make, and you look for opportunities that have, you have to have a financial return to even make it into the box of consideration. You have to have an appropriate financial return, and then we look for the impact return secondarily to see if we can create an impact for the union or for the environment, whatever it might be, to fit that particular thesis. So when you're managing institutional money or when you're a registered investment advisor, you have these things that can help you create impact through investments, but they also constrain you. One of the things that's interesting about your work is that for individuals or even for institutions, it seems it's a bit more flexible. So where we have to come out when we raise money, we say, this is our thesis, we raise money around the thesis. If you already have the money, you can be flexible in sort of exploring what your own values are, develop metrics around that, and that sort of thing. So
that can be applied to asset managers too.
Tell us more about that, Vanessa.
Maybe I want to come back to the journey from philanthropy to impact investing. We've seen a huge shift in, for example, our members, but in general, the foundations that have expressed interest in impact investing. For several reasons. I think if you have $1 and you want to create impact with this dollar, you can put it in philanthropy, you can put it in an impact investing firm, or you can put it in a normal firm. And what's very appealing to people for impact investing is that you're really proactive about your investment. You define what you care about, and you say, I'm going to find an investment that's going to help me achieve this outcome while I still have the financial returns, but I will focus on the outcome and the impact. So I think the shift came from having more and more entrepreneurs who came into that space and started to think about how they were going to donate all their money, usually first generations, and they were not in the mindset of I make money, I donate it. Maybe I make money and I make impact at the same time. So I think we've seen that shift in the past 5 years, and it's going to continue with the millennials very strongly, where impact and investment are going to be linked together, as one of the first panels said. In terms of investing itself, there are several vehicles, and you can blend philanthropic capital and impact capital. For example, I'm a partner at Acumen, and their first fund was a charity. They developed the concept of patient capital because they were investing in small companies, innovative entrepreneurs in emerging countries who were taking a risk and wanted to change the way that business was done in a specific area. And it's a risk for the investor, and that's why they call it patient capital, because they want to lock in some capital that might be longer than a private equity or usual VC investment, and they work with the entrepreneur to achieve the investment goal. So it's a very proactive investment. It's a personal investment, and even if endowments and pension funds are not persons, they can still have values that they want to invest in. The other shift that we've seen, and I'll finish there, is the shift from the foundations, where they really want to leverage their endowment money, and because now they see it's invested in the public markets, they're really looking at how it's invested. They're active in the divest invest movement. They really want to have their entire portfolio aligned with the mission of the foundation, and not have assets in the endowment that are not aligned with it, and which was the case before, and which is still the case with a lot of foundations, and they're struggling to realign everything.
Is impact investing necessarily a long-term or a longer-term play than traditional investing?
Oh, yeah, that's without a doubt. When you look at, again, just going back to the same case study, when you look at 1K, 1V, their minimum duration on any investment is something like 10 years versus your typical 3 to 5 years. So it is longer term, and there's a very good reason why that is so. I think when you do impact investing, you do not necessarily want to rush the management, right? So we as financial professionals, we tend to have this bad habit of financing, financial engineering. That creates, profitability short term, because we are able to, adjust things here and there, but it's not really value add. And so to really realize a proper value add in any portfolio company, you have to have that duration. You have to, first of all, you have to implement the strategy. And strategy is not an overnight thing, right? I know companies who implemented strategies that really took about 5 years to start working. So this is the same situation where you need to be patient with your capital. That's the first thing. Secondly, just to go back to the ESG method. The ESG method, it works very, very well, but there's one element that I think it misses, and that is the people. So it's environment, social, and governance. It's great stuff. But when we miss the core, which are people, and we kind of glaze through that as in social, right? Like, socially, we want to be responsible. When I managed this division at Citigroup, we had a day off for the employees where they just go and paint the school, and we said, that's our social response. That's not enough. That's not enough. So the ESG method has a fundamental flaw. So what I'm trying to address, at least in an Africa standpoint, is that let us granularize it. Let's get to the bottom of it. Who are the socialites, right? Let's get to the people, to the employees. I'll give you an example. One of the advisement I did for the 2 transactions I went for in South Africa was that when you give your employees multiple earning streams, you will essentially solve pretty much most of your environmental issues. For example, if an employee in a factory, they have market-related salary, they have individualized bonus structure, they have company-wide dividend payout structures, they have those multiple earning stream where they would now be able to afford a house, afford to take their children to better schools, be able to have a better health coverage. So you have solved a plethora of things with just focusing on people rather than saying we want to comply with the ESG method. So it has its positives, but it also has those shortcomings, and that's what we'd like to address.
And you guys?
Yeah, just to stack onto that, actually, this is loud. Those B Corp metrics are also applied in the investment realm with something called GIRS, GIRS, Global Impact Investment Rating System. It's based off of something called IRIS, so people who are nodding about GIRS probably already know what IRIS is, but essentially these are these menus of ways that you can measure impact. And the B Corp certification picks certain IRIS metrics and uses that to rate companies. In the same way, as an investor, you don't have to use B Corp or GIRS or even IRIS, right? There's a number of standard setters out there that have metrics, and you can drill down. And if you want to focus on employees, I think you're right that employees, it's becoming better understood that employees are real drivers of value. You have to invest in the human capital within the organization, and that's a focus for value creating investment. But you can focus on employees, and you have the B Corp metrics and GIRS metrics, I think, are actually really intelligent in some scenarios for how to evaluate whether a company is actually creating underlying value. So in the same way that you look at financial performance indicators for a public company or a private company, you have well-established sort of financial rubrics by which you rate companies. These are ways by which you can rate not only the impact that they're creating, but it's an insight to the underlying value creation performance. I'm not saying values like I care about human rights, although I do. I'm saying value creating, financial value creating. These are precursors to financial value. So that mindset of thinking of profit and impact as a trade-off, yes, sometimes it is. And sometimes it's the trade-off in the short run where you're investing in workers or a strategy that takes a long time to pan out. It's, many of these, if you're investing intelligently, you have ideas about what creates value. Some of these impact metrics are actually a good tool to use to get a lens into that value creation. It's nice because some of them are already sort of built out for you, so they're ready-made.
So I wanted to broaden the definition of impact investing so that we make sure that we don't just include the VC type of investments or private equity investments, because impact investing is broader than that. You can do impact investing in the public markets with the divest invest principles, or shareholder activism. That is really very, very impactful, and that's a way for you to utilize your money and balance your portfolio. Shareholder activism is very powerful for things you care about. There are some companies and funds which specialize in that, which you can work with, and they're there. They're working with the pension funds. They're actually very, very active, and they can transform corporation in a way that's very, very impactful globally. Like, for example, on the carbon footprint or on the LGTB policies or any other related, policies related to employees. So that's one area of impact, and it's sort of a shorter way of investing your money. On the VC and private equity side, you can invest directly in those companies, which is very hard, and I would not recommend you to do if you're not an expert. But you can also invest in funds, and funds are easier to get out of, so you don't have to lock up your money all the time. So you can also invest in fixed income. That's another, sort of forgotten area of impact investing. It can be corporate bonds, it can be municipal bonds, it can be pay for success. Pay for success is limited, but any social corporate bonds, green bonds. So don't think of, impact investing as one limited asset class. There's a lot of possibilities to invest, long-term and short-term and medium-term.
I want to come back to that as well, and you know, even an individual investor can get involved with this, with many of the ways that you just described. Would you guys agree? There's a notion out there that, you know, one of the things that holds back, you know, increasing popularity of everything that we're talking about is the tendency for Wall Street to be obsessed with short-term gains. And in fact, a lot of the ways that a lot of companies are run and the way that their incentive structure is set up, you know, wherein next quarter's results are more important than 10 years results in terms of how much my bonus is going to be, and all sorts of things like that. Would you guys think that there are problems, structural problems in place that are incentivizing short-term casino play on Wall Street, which, you know, is ultimately contrary to this whole bigger impact thing we're talking about?
Yeah, I think some of those issues stem from the corporate governance laws that govern publicly traded corporations and just traditional corporations. So there are different schools of thought on this, but this is actually one of the reasons that the founders of B-Lab created the Benefit Corporation legal entity. It's one of the reasons I'm sure Mark got behind the L3C, is that in a traditional legal structure, arguably, but not that arguably, the director's purpose and the corporation's purpose is to maximize returns for shareholders. And so when, you know, public markets are supposed to have the greatest transparency, which isn't always true, but supposed to have the greatest transparency, you're looking at quarter after quarter earnings and making your investment decision buy or hold. Or buy or sell or hold. So those legal structures that determine the fiduciary duties of the officers and directors of the corporation can be seen to incent or even require those folks to actually, you know, be narrowly focused on the short term. So the Benefit Corporation legal entity, or even just an LLC where you customize some purpose language, if you can actually bake these value-creating public benefit purposes or impact purposes into the structure that you're investing into, and that applies whether it's a grant, a loan, an equity investment, a royalty. You can get creative about how you want to earn your financial return, but I would really encourage people that are looking at making those investments to find a way to make sure that that impact is actually baked in. If you want to see the impact, if you don't care about the impact, then don't worry about it. But if you want to consider yourself an impact investor, I think it's foolish to invest in a traditional security that has no language around impact, no reporting requirements, so you know if the impact is actually being created, and think that you've just made an impact investment because the entrepreneur or the broker just told you, you know, yeah, they donate water or whatever, right? It has to be baked in order for it to be legit. So that short-termism, I think, is linked to some of the legal problems about whether directors and officers feel like they can pursue impact or purpose for its own sake.
How much of it do you think is perception, and or versus like a real threat that some shareholder is going to sue the company because they made a long-term decision about some environmental matter? Anyone?
I think that it's absolutely a concern of any CEO, right?
Yeah.
I mean, you're being judged about, are you being good stewards of the investor's money, right? And I'm not saying that it's a hands down, you know, slam dunk, open and shut case of if you try to remediate environmental wrongs that your company's, that's kind of the scenario you just tossed out there, that's not a smart long-term business decision, right? I mean,
Well, it might be a smart long-term decision, but it may cost you short-term, right?
Right. So as a CEO, you've got to weigh all these priorities, right? And meanwhile, the shareholders, if you've been in it for 10 years and you're ready to get out, you know, you're saying, look, you're not going to be around in 5 years to deal with that. You know, some of this impact stuff is also about risk mitigation, right? You can think about it as treating your stakeholders well, treating your suppliers well, because there's less chance that they're going to walk off the field on you, right? So, yeah, I think you have to balance that, but it's a concern of any officer or director to make decisions for the long-term impact purpose when investors want to see a return if you don't have a legal protection baked into the investment documents or the governing documents.
I want to give you guys a chance. Yeah, go ahead, Aubrey.
Yeah, so I think what you also have is the external and internal pressures in terms of short-term gains. The internal is that the investors, at least in large part for a publicly traded entity, they have these, active or activist investors that they want to see the CEO try and unlock some value short term, right? So that is much more internal. The external portion of it is comparing similar companies of similar size in the same marketplace. Maybe they might have done something different, and for this quarter's reporting, their dividends are a bit more higher, the stock is trending higher. So that puts tremendous amount of pressure on the CEO. Now, when you ask them, can you look long term, as Dirk put it so nicely, is that they do not know whether they will be around in 10, 15 years to see the strategy come to fruition. So it's constantly, what can we do for this quarter? I just have to try and get my investors off my back. And so it's a tough job. I wish there was an easy way to look at it, but it's not. And that's why these guys are getting paid huge amounts of money. But it's so stressful.
So I worked for the New York Stock Exchange for about 9 years, and I'm a bit more optimistic than everyone else here. Not because of the rules that are in place or the responsibilities of the directors, but because of the huge shift in the consumers and the requirements of the employees. And I think transformation of those companies will come from that. And that's what will put the pressure on the directors, because employees don't want to work for any company. They want to work for companies that make sense to them and that are not polluting the planet or not doing things that are not aligned with our values. And same goes for the consumers. We've seen during crisis in the markets that companies like Whole Foods or companies that are in the environmental friendly and impact space have done very well. And so they're very resilient to those types of crises. And so I think in the long run, you will see a transformation of the companies, because the shareholders, the employees, and the consumers will all be aligned to not say that it's not okay to have short-term results, but it's not okay to have long-term goals that are not that are not for the benefit of the whole planet, I would say.
Terrific.
Yeah, you might also see some kind of carve-out portion to the company. In other words, is the activist investors might continue to demand short-term profitability. But you might also see sort of like this hybrid where a portion would be long-term for the company. Said, okay, for this strategy in terms of impact socially, this is what we will do. And that will be much independent from the larger goal of the entity. That might be the way forward for a lot of these big corporations.
So one more question, and then it's your turn again. I have, let's say I have $100,000. What should I do with it? You first.
I tell you what we'll do. I saw a wonderful dealership. I think it's a Ferrari or...
Okay.
Let's just go right
Aubrey's going for the Ferrari. All right. That's an option.
I'm just kidding. Go ahead.
Well, you can come to me and define your values, and we can see, first of all, what you already own, if it's aligned or not. And then the way you want to invest it is, I would say, the traditional way of how you would want to manage your money, because that is a sound approach of, how do you plan for your retirement? How do you manage your portfolio? And so those key principles in terms of how you manage your monies are still valid when you do impact investing. So you have a lot of possibilities in the public market and in the private market, and you can balance that. And there are more and more products that are available, whether it be mutual funds or index, that track ESG or try to be specific on certain impact. You can also say, I really want to save the planet. Like, I want to put my money in, reducing carbon footprint, and find instruments that are aligned with that. And those instruments should be delivering you the same market returns as the general market. So, a balance of what you love, and keeping in mind that you are making an investment and you're not trying not to lose money and really make money. So
I would say, sorry, Dirk, but I would say that, so if you have $100,000 and you want to invest it, of course, I wasn't making a joke about the Ferrari.
I like Ferrari.
Sure.
So for private equity funds, that tends to be clearly small to get into, right? As you know, private equity's got this long-term lock-in. I would say you first need to define what you'd like to get out of it as an investor. And if you want to go short-term, then clearly wonderful advice that Vanessa just gave, that's the way to go. But if you are saying, look, I want to look more towards the emerging markets, and I'd like to get a vehicle that would do a lot of social good, but also have profitability, then you want to look at the impact investing private equity funds that accept endowment capital, wealthy families, capital, family offices. Those are the kind of guys you want to look at. But you also have to be very, very patient if you are investing in private equity. I think that would be the big difference. If I had $100,000 that I want to invest, I would definitely go short term. That's what I would do.
Yeah, sorry, just to contribute on that. I would say the issue that we see with with impact investing is the high hurdle rate of the investor. So you need to be usually an accredited investor and put in a certain amount of capital in those private deals. So that's an issue, and people are trying to democratize it and have funds where you have smaller tickets, where you can come in at 10,000, 20,000 sort of investments, but that's harder to find than the deals where you come in at a higher ticket.
Yeah, just I don't know that what I'm going to say is totally different from what they've said, but I think you start with your kind of traditional portfolio construction. What's your holding period? What's your expected or desired return? When do you want to achieve that return? What are your goals? And then you build your portfolio of, bonds, equities, fixed income, whatever, alternative assets. With $100,000, there's only so much diversification you can do, but there are, as you know, managers and products out there in the public markets. Calvert manages them. Domini, what are a couple other ones that are out there?
There's a robo-advisor called Invest Forward that you can invest with $500. You can open an account.
I think Impact Assets, manages and rates different products. So if you're interested in that, you can look up Impact Assets. But so that's kind of the traditional way to go, and I would say you'd do it the same way you would start by building your portfolio the same way you would build any other portfolio. And then you would apply your impact screen and say, within these asset classes or within these types of securities, are there opportunities that fit my impact desires? And if there isn't an opportunity within that segment, then you knock it out and you reallocate. But I'm an early stage guy, so I'd say find a really cool startup where you think you can have meaningful participation for $100,000. Go get a seat at the table and enjoy the ride.
I also need to know what to do with the 10 million I've got lying around, but we'll get into that. Okay, let's roll. Who's ready? I know we have budding impact investors out there. So right back here. Yeah.
Thank you very much. I have a question in terms of, you mentioned that there's a Gears or the Iris, which people can use to rate their investments, but who's rating, let's say, the funds or the different firms? Is there a Morningstar or a Moody's for impact investment firms? So thank you.
Yeah, Morningstar just released its ESG ratings, so there are several ratings available.
The way that B-Lab bills Gears, G-I-R-S, is Morningstar for impact, and so the investment managers will actually become Gears rated by rating their investments. So they do the analysis on their investments, and they report that. So you can actually go to, I don't know if it's gears.org or, but if you just Google Gears, you'll get to their site, and it should show you all the Gears rated managers and what their holdings are. It's something that it takes time for the managers to actually participate in that survey and do those rankings. So last time I checked, there was only, I think, maybe 30 to 50 that were rated.
Yeah,
there's the Dow Jones Sustainability Index as well.
What's that?
The Dow Jones
Yeah.
Sustainability
Yeah.
Index?
Oh.
Just
yeah,
gonna-
yeah.
Yeah.
Cool with
And
that.
also, there's no consistency in the measurements for the time being, so don't expect too much in terms of finding comparable measurements in every fund, because sometimes, it's even per investment that the impact is assessed. So that's a problem of the industry at large, that we don't have we have common tools, but we don't have consistent reporting of those tools for the investors to, at their portfolio level, really assess all the impact.
It's also a problem just with impact. It's really hard to measure some of the stuff that we're trying to measure. You can do outcomes assessments, but to make it apples to apples with, saving 500 trees versus providing water.
We have a question over here, but you might after this mention how HIP does it. I know it's proprietary, but Paul Herman, what is he? He weights the S&P 500 according to this set of criteria, and then created an index fund which he claims outperforms the S&P 500 by a couple points consistently,
Yeah.
because he's weighted it in this sort of, it's proprietary, but he's figured out a way that is as apples to apples as I guess you can
Absolutely,
do
yeah.
that,
So
but-
it depends on what you're looking at. So I think he's focused on the public securities.
Yeah.
Right, and he has a rating system that is proprietary. He came up with it. He's a brilliant guy. Definitely highly recommend that you check out HIP Investor. There's a book called HIP Investor. I think the HIP Investor, it stands for Human Impact Plus Profit. But it looks at environmental factors as well as human impact factors. And it's a really intelligent tool that digs deep into the impacts that each company is actually having, and then rates them in an intelligent manner. I don't know. It's probably the
Question back?
Is the majority of the social impact money coming from very wealthy families who are interested in this personally? But what about the institutions, and are pension funds getting into this? And if not, why?
For the pension fund, it's kind of a hard sell because their responsibility first is the police officers, for example, as their clients. So they tend to look more at market-proven strategies and just say, let's get our return and just keep it moving. I had an interesting conversation with an asset manager who represents New York State Pension Fund. And she said to me, if you gave us an option, being if you invested in an impact private equity fund that would return 16% versus a traditional entity that will return 15%, we'd take the 15% versus what we know. It's easy for us to report back to the board. So there lies a conundrum that so you have an opportunity here where you can make 100 basis points. Do you want to take that, but also do a lot of good? Plus, again, as I said before, it's a term that is not quite, known yet. It's still this fuzzy little word, even though it's been around for quite some time. But I do think that over time that will change. I think that funds that are being created by managed by large family offices like the Cause family, that will change the game. Eventually, the pension funds will see that, the institutional capital will see that, and want to get involved. But for right now, it might be too early for them.
I would tend to agree with that. I think that families and high net worth individuals, family offices, high net worth individuals, because they're less regulated, they're sort of regulated by what do they feel like investing in. They just have more leeway to take risks and to invest in projects that others might think has a more nebulous financial return, but it has a clear impact return. So you just have the freedom to make those investments where I do feel like pension funds are still locked into a sort of, a rigid, prudent man, very, historically established set of rules for
But at least
how
they can
they
think
have
long term, right?
They can think long term, and this interpretive release it makes it clear that you can consider ESG as a component, as an underlying driver of risk and return. It still doesn't say that you can sacrifice a tenth of a percentage point in financial return to achieve 1,000% increase in impact return. That's still not permitted, right? So it's only permitted as an underlying factor, and it makes it tough. I think there is a carve out for if it's actually to create jobs for the pension fund itself. They typically have a different vehicle to do those types of investments, but that's obviously not impact writ large. You can't do all kinds of interesting stuff, right? That's a narrow carve out. So I think there's regulatory hurdles to those folks getting involved. You have some of the same hurdles. Prudent man rules for endowments create some of the same problems. So from their perspective, they're not over here saying, why aren't the pension funds investing? They're saying, well, we don't have enough high quality financial investment opportunities for the type of opportunities that we're looking for that create also impact returns, right? So it's
But I would say that
pointing the finger at each other.
the foundations are at the forefront also of impact investing. Some are going 100% impact, like the Heron Foundation or the Cordis Foundation. They're really committed, and so once you're committed, you just do it. But the philanthropic capital that is converted into impact is huge in terms of the foundations and what they're trying to do with their endowments. So it's not as visible maybe, but it's true that they run into the issue of not finding always the right investments, but they're very active in it. And the family offices, I would say, the next gen really wants to get into the impact. The current, parents or grandparents are a bit more careful about engaging into that. There's a dialogue that's open, but in terms of funds committed, it's still a very small subset. So we're, sort of testing the thesis.
And I believe that just about wraps us up, unless we've got the fastest question that's ever been asked.
Just one
Go
real
for it.
quick question. As we do see a lot of these higher net worth individuals, large foundations getting involved in the impact investing world, and a lot of them have, a little lower hurdle rate, and they might have some kind of personal viability in the project, and they keep pushing it along as, it might need to just flounder. Do you think that could be detrimental long term to the impact investing world?
So can you say the question
Yeah.
one more time? There was a preamble. What's the question? Sorry.
So as a lot of investors with, as we see in impact investing, might have a lower hurdle rate, and they kind of want to just push projects that really deserve to fail along, is that going to affect impact investing in the long term?
You mean, yeah.
Wow.
Well, if there were major disaster stories, would it scare people off? You mean?
Yeah. I think you're saying if there's a history of failed financial returns on impact investments, how does that affect the future? Is that?
Well, no, more like projects that a wealthy individual say, I'm going to give $10 million to this project, and I thoroughly believe in it, but it gets 5 years later and nothing's getting done, and I'm still pushing it along.
Yeah, I think that's a function of management, but it's also a function of, in most cases, regions, right? Families who tend to do that, they tend to look internationally in emerging markets, because they have affinity, for certain, countries or regions or continents. Look, for the impact investing side of it, just like your traditional investment, we will have some failures, right? We will, in some cases, make a bad call, but it doesn't mean that over time will diminish the attraction of impact. It just means that, we have to be more prudent with investors' capital, be it, my capital or your capital, because for me, I believe I'd rather have less return, be safe, than go for home run and fail spectacular, or hit it out of the ballpark. I guess you can say I'm much more conservative, and that's what I believe in. Let's have the right measurements in place. Let's try and advance the ball down the field. And if we get a goal, let's get a goal. But let's not go for, half a court, 3-point shooter, and you miss it spectacular.
Yeah, and, take, like, in my neighborhood, $10 million investments vaporize all the time in Silicon Valley, and that hasn't slowed anything down there. maybe it should in some ways, but
Yeah, there are some failures. For example, one of the Pay for Success bonds was a failure. There's tons of them, and it's still going strong. And you know, people believe in the product, but you need failures also to learn from them, and hopefully not to the detriment of the people that you invest in, and the purpose you invest in. But there will be market failures. That's obvious, right? And I believe Florida is going to adopt the Pay for Success legislation. It's already in the works. So there are 3 new products that came out this year, and banks and individuals and foundations are subscribing and putting their money there. So it's not an issue.
One of the things that Jack Welch said during one of his conferences that I attended, which I thought was so spot on. He talked about when he was the CEO of GE, his pet peeve was people who never wanted to put themselves out there and take the necessary calculated chances. He said those people were a dead weight to the entity because they did not, innovation, taking the proper calculated chances, basically it's something that I voted by all choices because they believed, well, I have to see Jack, and I have to tell Jack why this project failed. So I'd rather not do it at all. And that in itself is not what you want. So you want people who will take the proper calculated chances and weigh their risk versus returns and go for it. We will fail, but we will also succeed as long as we are calculated.
all right. That's a wrap, guys. Round of applause for our panelists. Thank you guys very much.
Thank you.